The obvious hot point in the market today are US and Chinese trade tensions. I'd argue that the trade war is not so much a trade war as an armistice when you take a longer view of the relationship. Nevertheless, that's a conversation for another day. Today, I think we can focus on a few markets that are reflecting the power struggle. Let's start with the dollar index. It's been fairly stable so far this year, trading a range between 95 and 99, and it currently sits towards the top end of that range. Momentum is fairly neutral too, as are the moving averages. The trend is to push higher, despite repeated comments by President Trump about wanting a weaker dollar. Something to consider might be, with China's desperate need for dollars, a strong dollar actually boosts US interests at the moment. Moving to dollar yuan, we can see the pair trading at 11-year highs, with the initial break above 7 causing shock in the financial markets. The official explanation has been that letting the yuan slide is an offset against US tariffs. But is this the real story though? When we look at the dollar yuan set against the CFS RMB Index, which is a basket of regional currencies, we see that it is very much in line with its implied basket. The implication is that the push above 7 is a dollar move rather than anything instituted by the CCP. Now, let's have a look at the yuan offshore onshore spread. We can see it spiking, indicating that money is flowing out of China at an accelerating pace. So why does this matter? Well, according to official data, Chinese companies owe foreign creditors approximately $2 trillion, with a significant wave of repayments scheduled for 2020. According to Bloomberg, a further $650 billion should be added to that total via onshore entities. This is a huge cliff to scale in a country that has a weakening currency against the US dollar, no sign of a reduction in tariffs, and a huge existential risk to its access to the dollar if it continues to mismanage the ongoing protests in Hong Kong. When the yuan devalued in 2015, foreign debt servicing contributed to a rapid decline in the country's FX reserves. This time around, analysts expect current reserves to just about cover costs. The pressure isn't just coming from that area alone. In recent months, it's been reported that a number of regional banks have had to be bailed out by the government, with 20 institutions delaying disclosure of their 2018 annual reports. With tariffs forcing Chinese producers to slash prices in order to maintain competitive pricing within the American market, it's understandable that this is translating to repayment pressures within the Chinese financial system. And now, with Hong Kong demonstrators refusing to back down, there have been calls by protesters to initiate coordinated cash withdrawals to instigate bank runs. Now, the above can be interpreted as pressure mainly on the CCP and corporates who so far claim to be unmoved and able to withstand the pressure for the next year, potentially in the hope of welcoming a new accommodating president to the negotiating table. The ordinary man and woman are broadly unaffected, or are they? An interesting chart I found pitted pork prices against the yuan. China consumes over half the world's pork and is undergoing a swine fever epidemic that might mean some 20 million pigs need to be culled. Furthermore, with President Trump piling on pressure for US companies to exit China and move their operations to within US supply chains, that creates job losses in a nation that needs to create tens of millions of jobs a year just to maintain social stability. In all, it looks like the CCP is facing a perfect storm. It has a political minefield to resolve in Hong Kong, a building dollar crisis, an unstable banking sector, and gradually building pressure on its citizens. I can't recommend any specific trades, but I recommend that this is an area that you keep in focus. Thank you.